Welcome to the exclusive Franchise Registry Members Only webinar provided to you by Daryl Johnson, FranData's CEO. Daryl is the major economic forecaster within the franchise community. Daryl addresses the economy and where we are heading, possible bumps along the way, and most important, concrete ways in which your concept can position itself to be seen in the best possible light to the lender community. Thank you for listening, and thank you for being a Franchise Registry member.
Welcome to Insights into the Future on Franchise Capital Finance. Peter Drucker, the great management guru, once said the best way to predict the future is to create the future, but you can't create the future without having an understanding of what that future is going to look like. What I'd like to cover here are two things. One is what is happening in the general economic environment over the next couple of years, and then secondly, how the lending community is adapting to that as it relates to small business lending, where most of the franchising world resides. In doing so, I'll frame it the following way. Lending at a very basic level in business lending has to have some sense of what is going to happen over the next couple of years, more importantly than the long term or the next 12 months. We have found in franchising that typically the most vulnerable period for a new franchised unit is from about the second year to the fourth year. Therefore, from a lending standpoint, the greatest risk for a lender is in that window of time. Typically at the front end, the lender and the borrower, the small business, make sure that they have enough working capital to get started. So that first year or so, generally, even if they're having problems in getting rolling, there's enough capital to cover it. Sometime in that second year, either the unit is starting to gain traction or it isn't, and by about the third or fourth year it's either going to be stabilized and successful or it isn't. And that's the vast majority of the franchise community's experience and our observations on it. Therefore, what is important from a lender standpoint is not to try and predict the future, but it's to try and understand what's likely to happen in that second to third year out from where we are today, because that's where the greatest risk is. And they want to make sure that from a lending standpoint they're not getting into another situation similar to what we had in the 2007 to about 2009 period. So let's look at what we are going to encounter both from an economic perspective, and I'll run through that quickly, but then how the lending community is adapting and changing and how they're viewing franchising differently today, and some of the technology and tools that they're using. To start with, one could say what's to worry about? We are in an economy where the consumer confidence is at the highest level. Most of the high school graduates today weren't even born the last time we had this high a confidence level in the economy. That's a pretty powerful statement. So what's wrong? And disposable income, as you can see, has grown nicely, even with the two recessions that we've had in the last 20-some years. It's really been just minor adjustments. And of course, by extension, if disposable income is generally rising, so is consumer spending. So what's the problem? Why would we be concerned? Well, there's always gray clouds somewhere out there, and here it's pretty clear that we have stretched this economic expansion period about as far as we can stretch it from the consumer standpoint. Consumer power is about 70% of the overall GDP changes. Therefore, what the consumer is doing and feeling is going to substantially influence what's going to happen to the economy generally. And there are two things that I would comment on here. First of all, credit card debt and student loan debt, two leading indicators of how households are feeling, they're at all-time highs. Overall, household debt is also at an all-time high. We didn't bring down from the last excess period of the early 2000s, from that break when the Great Recession hit, it started bringing down household debt. But now it's reversed and it's been growing over the last 4 years. And while that's okay, it takes away some of the cushion that would otherwise be there if we do have a weakness overall in the economy. Households just don't have as much capacity. On top of that, as we start to migrate into what are the implications from the lending community standpoint, the new tax bill has to be funded because it's created quite an additional deficit for the government. So the government's going to be competing for borrowed funds in a substantial way, $1.2 trillion. Corporate bonds are in the neighborhood of about $600 billion over the next couple of years that are in typical borrowing needs. And then on top of that, we have what is really a dramatically changing real estate environment where there's the bondholders are going to be increasingly forced to pick winners and losers from the retail properties, as we know, that have really had a lot of stress. And that is going to be in the face of the next 2 to 3 years out. All of this is kind of converging. One final point on that, and that is just the gap that shows up between the on the retail side, the store closings, which have been more frequent and expanding in rate more than store openings. And so you take the retail component of that on top of the consumer component with household debt, on top of the government's almost insatiable demand for additional credit with the new tax bill. And the implication is clearly we're going to have rising interest rates. The question is whether the Federal Reserve can control what's about to come over the next 12 to 24 to 36 months as we encounter that. And as we know, we're in the second longest running expansion in modern history. And we do have economic cycles, and we have economic cycles for a reason. They tend to be a cleansing of excesses. While we don't have any bubbles, and that's the good news this time that have been created along the way of this expansion period, we are getting to a point where it, more likely than not, is just going to run out of steam. There may be a triggering event, whether it's tariffs, trade wars, that sort of thing, but whatever it triggers it, there's no big bubble behind it, which is the positive. However, with household debt being stressed, with so much demand for additional capital coming into the capital markets, we really do have a lot of potential for a slowdown in the economy coming up in the next couple of years, and that's the environment that the lending community is looking at today. Small and medium business lending, if we switch to what the lending environment is, how that's unfolding right now, what this chart shows is overall, the bars are the overall growth in lending for commercial lending in total. The gray line that comes across is the portion of that total commercial lending that is going to small and medium business lending borrowers. And clearly, it's becoming a less and less of a component. In other words, the larger bank lending is disproportionately shifting towards larger entities and moving further and further away from small businesses. That's been a pattern that's gone on now for the last 4 or 5 or 6 years, and the reason for that is efficiencies. A lender that has to underwrite a $300,000 loan has to put about the same amount of labor effort into it and the same amount of underwriting effort into it as they do for a $3 million or a $30 million loan. It's just not as cost effective. And in a $3 million loan, they can cover a lot more of their fixed costs up front than they can in a $300,000 loan. So larger banks have moved away from that. Filling that void were the smaller banks and then the alternative lenders. But now we're seeing a change dynamic there as well. The alternative lenders, the platform lenders, the organizations that are trying to use technology as a solution actually made some pretty good replacement of the bigger lenders moving away from the small business lending environment over the last 4 or 5 years. Now those banks, small, medium, larger banks, looked at what the alternative lenders did and said, maybe they're onto something in terms of solving that labor issue for us and the fixed costs up front. But we got to be more selective, and the question is whether it is working for the alternative lenders, and if it is, then we're going to see the copycat side of it. And the answer is it generally seems to be working for the alternative lenders and those banks that have started using much more technology-driven credit decisioning and far less putting BDOs, business development people in the field serving individual small businesses directly. And so that transition from labor to technology has been happening over the last 4 or 5 years and has been tested a lot of different ways. This essentially was the evolution of why FRANdata came up with a fund scoring model similar to a FICO scoring model that was applied in much the same way that FICO is for individuals, which is to say there are certain credit criteria that can be looked at a brand level, and this only works for franchising. Independent businesses, there's no way to assess their performance history in a way that would inform a credit decision today. So if I'm a lender, I have two risks that I have to assess as I look at a small business borrower if they're a franchise. One is the borrower. What are their financials? What are their capability to actually run that small business? And that's what lenders are really good at. That's what they do every day. The bigger challenge that they had was there's 3,600 franchise brands out there. There's got to be differences in risk profiles across all those brands. How do I bring technology to bear on it that actually helps me understand that so I don't have to have my underwriting team spend a whole lot of time waiting around in FDDs and SBA data and things that are out there and try and make sense of it when they're not experts in it and they don't understand the comparisons because they don't have access to the comparisons of how one brand does to another. And that's what led to the use of fund reports. It was first used by the platform lenders, the alternative lenders that were saying, if you can help us on the technology side solve whether brand A has a better risk profile than brand B, we can take it from there and figure out whether that borrower is somebody that we want to deal with using FICO scores and so forth. And so that's how it came about. And what we have today then is a funding score model that has been used by the lending community for 600-700 brands, and they're done annually now. And the content of them is now fairly refined, and what this has done is it has allowed a lender to look at a brand and say, if I have the same borrower and that borrower is looking at two different brands, I can distinguish the probability that I'll get my money back between brand A and brand B for that same borrower. If the borrower has a credit risk profile that I've already evaluated as a lender, the question is, how do I evaluate it against brand A or brand B? And that isn't to say that a lender will say, I won't fund this borrower for brand B, only for brand A, but I may want to change the terms. And in some cases, I may want to draw a line, just as with FICO, and say anything below a certain score is too low for me. And we're seeing that now in our full subscription lenders. And these are some of the biggest SBA lenders. Half of the top 10 lenders, SBA lenders, are now using the fund scoring model as a way of informing their credit decisions with the brands that they want to work with. As you can see, there's 12 categories here. They're broken up into 3 groupings. The history that has to do with how the franchise system performs, the more recent and more relevant history as it relates to what the franchisor's performance is, and this has less to do with their financial information. Clearly they need to have enough financial capacity to support a system, and particularly one that's growing. And then at the unit level, what is the projected, and this gets back to my Peter Drucker quote, the best way to predict the future is to create the future. A lender can look at a fund model, look at this set of scoring criteria, and have a more informed judgment about how this brand fits in the context of other brands. What we have found as a result of this, and having done this now for hundreds and hundreds of brands, is there is a grouping of scores that sort of just cut across, as we've displayed here, 4 different levels. And those 4 different levels generally have aligned with stress testing and performance testing against historical data, including SBA data for these brands, in how it actually creates a predictive model for the lender to have a higher degree of comfort about how a particular loan is going to perform. And where we've found as a result of that is that about 13% of the brands are in that high-performing category, 750 to 950. The biggest single grouping of these four are the under 550. And that isn't to say in franchising there's a disproportionate number of brands that are that are bad performing brands and higher credit risk brands. What it typically is saying is there's a significant number of brands that have transparency issues in one or more of the categories that we're looking at. And those transparency issues, whether the obvious one is an item 19 that has enough substance for a lender to look at and say, now I can make a judgment about how much working capital this borrower really should get in order to make sure that they can get through the period that in that 2 to 3 to 4 year period that is the greatest risk for the lender. But it cuts across other areas as well. And as an example, oftentimes a franchisor will show that they have a lot of units that have closed for other reasons. If I'm a lender, I can see the ones that were terminated and count those as bad outcomes. But when there's a significant number that closed for other reasons, as a lender, I don't know what that means, but I know it doesn't sound good. And therefore, in something like historical unit success rate, I have to discount those in a way that actually lowers the score in that algorithm in that category. And applied across all these different categories of 12, there are oftentimes transparency issues that if the franchisor is aware of them, they know at least what their range of possibilities are that they can use to solve for those transparency issues. That's what the fund score does, not only for the lender on the credit risk side and the underwriting side, but also from a franchisor's perspective and understanding how the lenders are seeing them and what that means.
What does all this mean to an emerging brand? You don't have the information with which a lender can make the assessments that I just talked about. You don't have the history in order for a lender to make judgments about where you are strong, where you're weak, and whether they want to expand business with you or pull back on it. They don't have information to help them understand how to structure loans because you haven't had enough history to show the kinds of performance characteristics that would guide them in that process. So what do? Well, the first thing you did was get on the franchise registry. Being visible to the lending community is the most important first step that you can take, because if they can't see you, they can't even consider you. The franchise registry gives you that visibility. Secondly, if you look at each of the elements that go into a fund report, each of those categories are factors that to some degree you can influence as you build your system. For example, historical unit success rate is a heavily weighted factor in the performance of a brand. Obviously, if the unit doesn't survive, the loan doesn't survive. And so that's an important focus for the lender. As you start to build your system, and as you look at those first few franchisees, some of whom may not be quite right for your system long term, how you handle that is going to substantially influence how lenders perceive you down the road. In other words, if you just shut them down, push them out, close it, it shows up as a negative in the calculations that will eventually, as you get big enough and have enough history, come back to hurt you, because this is an 8 or 10 year analysis. Therefore, consideration of what is the way you can exit an uncomfortable relationship, what is the way you can identify early on that it's not working the way it needs to work, that you may be able to turn it around and fix it so it doesn't become a problem. Those are aspects of how you build a system well early on that leads to much more efficient and attractive business down the road. Management disproportionately spends time in the early years on franchisee challenges and issues that come up. Obviously, you're learning, they're learning, and as the system evolves, that learning process leads to a lot more attention to your existing franchisees. Over time, as you build a system and you have existing franchisees that can help educate, guide, and stabilize other franchises. Your training programs, your field support programs get into a rhythm, and all of that starts to click the way it's supposed to. The focus in understanding what I just went through on the mature side should help guide you on some of the things that you are doing today that may give you more guidance on greater attention to detail of certain things that lenders are looking at. They're judging you on. Knowing those things help you to form a better plan over the long term. I will end this discussion and turn you back to your account representative to discuss this in more detail. But with this guidance, hopefully you'll have a better understanding of the perspective that a lender has about your system both today and over time.